How much are your competitors charging their employees for healthcare costs? And is this a lever that you should be considering pulling as you're trying to build an attractive compensation package to pull away that top talent? Let's talk about it a little bit deeper in today's Benefits Barbecue. So I've got two data sources that we're going to pull from to look at this and consider this question. Of course, as you probably are aware, most employers require employees to contribute at least part of their healthcare premium, the cost that you have to pay to the health insurance carriers every month, in order to have these healthcare benefits. This does make a lot of sense because healthcare is very expensive, and the downside of just offering it for free and having people double up coverage with being covered on a spouse's plan as well, or a government program, it can be hard and it can be a bad use of your limited resources as a business if you're just rolling this out for free. So I do believe in some level of cost sharing just to make sure that people actually want it and they're not just taking it because it's free. Having two life insurance policies can benefit your family if something happens. Having two health insurance policies very rarely will offer a significant upside for you as a business or the individual. So let's talk through the actual numbers here. You see on the EASE report, so EASE is a benefit admin system that manages the benefits enrollment for small business, and they define that as under 250 lives. To a lot of us, they say, hey, a business that has 200 people is still a pretty big business. But that's their data set is businesses 250 and under. They are seeing on average a little over just shy of 73% of the cost being paid by the company for employee only coverage. And when you move over to family coverage, that moves down to about 61% of the cost being picked up by the company. So those are the benchmarks of what the market sees overall. Again, this is dealing with a lot of companies and a lot of size, though. So let's dig in a little bit deeper. If we go a few pages down on this report, we're going to be able to see the actual premiums up here. Again, what you pay the insurance company or you're funding yourself. And then down here, we're seeing the actual employer contributions. So you see, here's the benchmark of all employee sizes, and then it breaks it out by 1 to 10, 11 to 50, 51 to 100, and 101 to 250. And you can see there's a pretty big jump there, right? The average across the board was at 435 in 2022. But the spread going from 403 to 443, that's a pretty good amount of jump, right? So that may impact your decision making a little bit to make sure that if you're only trying to hire against a certain segment of employer, maybe you need to look higher or lower. Going to be up to you to figure that out, right? And you see as well here the percentage of the premium contribution over the years. You'll see that on the employee side, this is going down a little bit, even though the money's going up, and that's just because the cost of healthcare are going up as well, right? So that's the data for employee only. For the employee contributions there, here's the family. So you see again, and family contributions gone up by almost $100 a month on average there. But there is a pretty good disparity between what a small employer is willing to put in for family coverage versus what a employer with at least 100 employees is willing to put in there. That's $150 almost there. So that's a pretty big jump, obviously. What do you want to make of this? For this data set, I would say that in general, employers expect to put in a pretty hefty contribution for each employee on their health care. One big mistake that I think a lot of employers make is that they don't highlight that they are actually paying for somebody with family coverage an extra $936 a month to help make that family coverage happen, right? A lot of employers just say, we're not worried about that, or they don't want to highlight how much they're putting in per month on there. I think that if you're spending this much money per family member or per family, tell them about it, right? Let your employees know, hey, this is an expense that we incur on your behalf. Or even if they're only on employee only coverage, that's an extra $435 a month that you're putting in to make their health care more affordable for them. So I would highlight that if I were you. Second thing that I wanted to look at here is the report from United Benefit Associates. And you see the percentages on here. So UBA works with typically a little bit larger of a client than that 250. They definitely don't cap there across all the affiliate offices they have. The employee only rates stay pretty well in line with what Ease sees there, about that 74%. But what's interesting is, especially when you add in those larger companies to the mix, the family contribution actual dollar amount is pretty close to what the Ease benchmarking report says, but the percentage is a lot lower than what Ease showed on there. And I think that's because when we look across here, larger companies have been willing to ask employees to pay more for family, spouse, and child coverage than smaller employers have. There's a lot of thought process behind this. There's a thought train you can take to say this is valid and we need to charge people taking that kind of coverage more because of adverse risk factors that are affiliated with spouse and children. There's definitely a thought train to follow that says, hey, this is ridiculous to say just because your spouse isn't actively at work, you need to pay 10% more, 15% more. What's the right decision? I don't know. That's going to be a case by case scenario that you need to decide as a company. But it is an interesting data point to look at here. So that's a couple of big picture levers here. If you're considering from a talent retention standpoint and attracting these employees, does pouring more money into the employee benefits package make your offer that much more outstanding? I think it depends. If you're way below these benchmarks and the employees coming in are used to paying on average, let's say $150 a month for their employee only coverage, and you're asking them to pay 225, 250, a little bit more money may make your offer more appealing now if they feel like that's at least a level benefit instead of a significant cost rise, right? On the other hand, if they're coming in and saying that it's going to be so much cheaper, it's hard for an employee to view that as a pay raise, even if it is practically a pay raise, right? If you offered them the same salary they have today, but your employee benefits cost half of what their employer is currently charging them, then they're getting a big pay raise, right? But employees don't often think that way. So I would say that you want to make sure that you're at least around the average here. If you want to go up a little bit for employee retention, that will help you keep your people, but will it help you hire new people? It's a mixed bag. Some yes, some no. I don't have a good scope of what the big picture looks at there. My friend Cassandra might be able to help you out a little bit more with that. If you want to get a copy of either of these reports, just put a comment down below and I'll be sure to email it over to you. Talk to you soon.